All right. Well, for the next hour, we have two different debates that are happening on this stage about venture capital. So for the next 25 minutes, we'll be talking about talent and valuations, and then the second half hour, we'll be debating the role and impact of mega funds on the early stage venture ecosystem. So today we have Sandeep, who's the head of investments at Prosus Ventures. We have Anu, who's founder and managing partner of the Avra fund. We have Kirill, who's the founder and managing partner of Conjunction Capital, and Grant, who's a managing partner of Hangar 75. The way we're going to structure this conversation is we're going to establish a set of premises or topics. We'll hear a point and counterpoint from each side, and then we can have open commentary and discussion to wrap up. So we're going to start with this question or premise, which is where does the next VC dollar create more durable value? So if you're a VC and you're investing in a company, do you want that marginal dollar to go into people and hiring or to execution systems or product, R&D, that kind of thing? So to talk about the point counterpoint on the marginal impact of a VC dollar, we're going to hear from Grant and then Anu. So Grant, do you want to offer an initial reaction?
Sure. They probably have some comments on the talent side, how to create it, how to get more of it over time. But I feel like we're actually at a position where the next marginal dollar can produce serious value in a number of ways using existing tools, existing people. The systems have gotten to a level that I feel like we can redeploy capital through some people into products that transform industries for people, for companies that are looking for solutions. I'm part of a venture studio as one example, is I think you can just take things, build a product that solves something. I'm also part of a corporate venture capital group, which is, really believes we can create solutions for companies who are scared to death of the AI story. So it's not, there's going to be a certain competition among some to be who is the very top of the pile at some level, but they're also creating tools that all the rest of us can use. It takes some talent in order to execute it, but I think the execution, the ability to translate what already exists into dollars is significant, and there are real gaps in what's actually being done. So I would actually say that's where people should be, concentrating. Where is there some level of talent that can be put into a structure that solves something for a particular buyer?
So it's obviously, it's hard to generalize, but a startup raises money from a VC. Let's say they raise $5 or $10 million. Do you have any theology on how much of those dollars should go into hiring people versus other ways of spending that cash?
Well, from a perspective of talent, I think that talent can be found in some of the frontier markets at a lower price, at a high enough quality. Maybe it's, again, not the top 20 talent on earth, but it's high quality people from other locations. So money is part of the equation, and they need to be paid well, and they're more important than any other talent sector. But I don't think talent needs to drive.
Okay. Anu, do you want to share your thoughts on the marginal dollar? When is it wise to invest in hiring versus other functions of the business?
Well, great. My background is I worked at Andreessen Horowitz. I started my venture career there and then was at Y Combinator. So I feel like I have to argue that talent and people are how we invest in, because if you look at the businesses on the NASDAQ that have done very well over 20, 30 years, they are founder-led. And if you look at a startup in the early days, it's the team that makes the company. You can take any technology, you can build a product that, that early on works, but for it to scale, to have a moat, the best teams always figure it out. So I always say bet on the best team. And if it means, like one of the analogies I give here is the top CEOs often say this, the one senior leader that they hired that worked really well in the early days is like a unicorn hire. And they can give you 10,000x. It's unlike baseball where it's not like, you get a few runs, you can actually get 1,000 runs, which Jeff Bezos has the same analogy. So I do think investing in some of the people early on who can really drive incredible returns that compound for years, not just 2 to 3, but can compound for 5 to 10 years. So I always lean on people, and we also invest in teams based on people. For us, teams come first, product and moat come second.
Yeah, and it seems like in this, like the future of the economy is a market where there's high returns to superstar talent, where companies will say we'll have fewer higher paid people because we can get so much leverage out of software and AI. So it does seem like investing aggressively in the most talented people, but then keeping the overall headcount lower is likely the path of the future, right?
Yes, I do think there's a nuance there, though. I think if you end up paying a lot of cash or a lot of equity, which is outrageous, that is just solving your short-term pain, and they're mercenaries. I mean, we saw that in some cases, like the co-founder of Thinking Machines went to Meta. So you don't want to do that. You want to hire the best. You want it to be in the realm of what you think is reasonable, and I think that investment you should make.
Got it. So there is such a thing as paying too much for talent and perhaps screwing up the culture.
Yes.
As a result of that.
You don't want mercenaries, basically.
Yeah. Well, I think the Meta AI talent acquisition game is the ultimate example of this, or the ultimate experiment that's being run in real time, which is what are the cultural effects of building a company where the employee next to you might be getting paid $100 million and you're only getting paid $1 million. Can the two of you actually collaborate and team up effectively? Do any of you want to comment on this broader dynamic?
Sure. So I would add a couple of points. So first of all, amazing talent and great teams. Unfortunately, not always are making great progress. Obviously, we know that super successful companies used to have great teams and exceptional talent, but sadly, statistically, many great teams actually fail. And the beauty of our profession is that there's no cookbook. There are no checklists which are totally verified, and even tier one investors are missing unicorns and or supporting companies that are never make it to the unicorn status, and vice versa. Even the first-time funds, first-time managers find sometimes great companies, exceptional teams, and there are so many unpredictables and so many uncertainties in the industry that it's a kind of a mix of certain science and of course an art and feeling of a VC.
Well, I guess to the question of science and art, we're talking about talent and the marginal impact of venture dollars. It is interesting, are CEOs today more able to evaluate talent than they used to be because, can you use data systems to better assess an employee's ultimate potential? We've seen, and I'll give you a chance, Sandeep, in a sec, when hiring technical talent, a very obvious thing to do is to look at their GitHub repos and see how active have they been in contributing to open source and so forth. That would be an example of using data beyond just what's on the resume. But you could argue that if LLMs are the future, maybe there'll be new and different ways that companies will be able to spot talent, evaluate talent, underwrite talent, to have the conviction to spend a lot of money on that talent because you have more signal than just a few interviews and some reference checks that this person is extraordinary. Do you want to weigh in?
I think the only thing that I would add to what's been said is we try and think about these things in terms of frameworks. So fundamentally, if I try and draw somewhat of a circle, there's capital, there's founders or founding teams, there's talent, there's people, technology, there's customers, there's revenue. And when we talk about the marginal dollar, just to borrow your phrase, I don't want to overly generalize about where are we in the journey. I believe Grant mentioned it's very different for a seed stage startup versus a pre-IPO startup. And fundamentally, when we're trying to advise some of the founders that we work with, it's just about, hey, are you at an earlier stage where the capital is there to attract the talent, or are you at a later stage where the capital is there to build better products and systems? And what, from your perspective, is going to give you that leverage to build that generational business?
Yeah, totally. I mean, I think it's worth emphasizing in terms of the framing of this conversation that it depends is the right answer to everything. And certainly there are differences between early and late stage businesses in terms of the marginal impact of venture dollars. I think it's probably most interesting. What we see in the early stage venture ecosystem is companies are raising meaningful rounds, but hiring far fewer people than they used to because they think they can get a lot of leverage out of software and AI, and ultimately not raise as much venture capital overall, which is excellent news for the asset class because it means less dilution, more efficient businesses. Okay, let's pivot now. So that discussion was on the marginal dollar test. Should the next marginal VC dollar go into people or R&D and execution systems? Obviously, it depends. Let's talk now for our second round about valuations. When VCs are valuing businesses, to what extent should the valuation analysis reflect the underlying IP in the business, or should it really be an underwriting driven by the talent of the CEO? Right? Let's say you're evaluating a business with an extraordinary CEO, but no real IP, no real competitive edge demonstrated through its product and so forth. How should you weigh founder quality in that valuation analysis? That's what we'll talk about now for the next few minutes. And Anu, why don't we start with you to talk about the importance of founder quality, where maybe a company that has no product even built or no product moat, no product market fit, can still command huge valuations because of the pedigree of the founders. How often does that happen? And what is the pedigree that you're looking at that would cause someone to be able to raise at 20, 30, 40, 50 million post-money despite not having built anything?
Yeah, good question. I don't invest in early stage for this reason because I don't know how to just assess based on pedigree. But I will say at the growth stage, which is like the series B through D, which is the stage I invest in, and typically founders have 5 to 20 million in revenue. The quality of the founder, again, does matter more. But I think this question the way it's set up, makes it sound like they're two different things. If you are a really good founder, you are thinking about competitive differentiation. You are thinking about long-term durability of your business model. Those are characteristics of what makes you a good founder. Just because you worked at Stanford or you did some research, you're not going to get an automatic thumbs up. That just says, okay, you have the technical chops. But what have you demonstrated in the 3 years since you've been building in terms of the quality of the team that you've built, the differentiation of the product, the customer love, the durability of your business? And really good founders often think about that way in advance. And I think it's a misnomer to say, oh, this is a great team. And then, well, how did you qualify they're a great team? It's not just based on your degree. It's based on what is the thought process you have put in to what are you launching, what's the type of product. So I do think that when we say, hey, we invest in great teams, they kind of check the box on clarity of thought, competitive differentiation, moats they're thinking. Remember, almost all startups have no moat. And
almost all startups have no moat.
Almost all startups have no moat because they are dead on arrival.
Yeah.
If it's going to work very well, you have all the incumbents using them as R&D projects to work on the next new things.
Yeah.
So I do think the quality of the founder ties to how are they thinking of staying ahead in the race, what's the differentiation they bring, and the speed with which they move.
Just to double click on one thing you said, it's a little bit of a detour from this conversation, but you mentioned clarity of thought.
Yes.
And I think we all are looking for clarity of thought from founders. It can be a little mushy in terms of how do you define clarity of thought. But one test that I apply to myself is I kind of say, if I'm not able to understand what the founder is saying, it's not because I'm an idiot, it's because probably there's some communication breakdown. Like founders should be able to explain their business to non-experts in a compelling and gripping way. And that's part of the clarity of thought test for me is, like, do I understand what's being said? And I think a lot of investors can make the mistake of, if I don't understand this because I'm not smart enough or I'm not deep enough, But even generalist investors should be able to understand highly specialized businesses if the specialist entrepreneur knows how to communicate what their business does. And so I find just asking myself the question, am I grokking what's being communicated, to be a way to tune into this question of, does the founder have clarity of thought, clarity of communication?
And in even next iterations, when you are able to explain what this founder is doing to your 7-year-old or to your senior parent.
Yes, yes. Yeah, you should be able to, it's kind of like the line of, a test of man's intelligence is his ability to make a summary. LLMs are great at this, but you should be able to like summarize a business at many different levels of sophistication. Like I think world-class founders can go on CNBC and talk to a total mass market financial audience about their business, and then an hour later go into a conference of specialist academics and talk about their business in a slightly different way. And to be able to do that is the sign of a founder who's thinking clearly and communicating clearly to connect with a diverse set of audiences. So why don't we now shift to Kirill. We're talking about valuations and the extent to which they should reflect talent of the founder versus the IP that's built in a company. So do you have a perspective on, you're evaluating a business, you're trying to assess its proper valuation. When are you weighing, when are you meeting a great founder and saying, yeah, you're talented, but there's no moat, there's no real IP, there's no product market fit, the market's bad, I don't care how talented you are, I'm not going to give you a high valuation?
Right. So first of all, I'm not a big fan of high valuations. Even irrespective of if it's like the first round for me or it's a new big round for my portfolio company, I think it's like very tricky. So if the company raised at a high valuation and eventually in the next 12 months or more will underperform, this high valuation which happened will be a big problem for everyone, for the founders, for the current investors, for investors that joined, for the prospective new investors as well. So big valuations is a big problem usually. Unfortunately, more and more we see pretty inflated valuations, and it's not necessarily an outcome of a serious analysis from any of the parties or any of the investors participating. Sometimes it's pretty much a competition-inflated process, and also another angle, which is like how quickly a particular venture capital firm can do the decision making. So we won some deals because we were like super quick. So I personally committed a couple of, actually more than a couple of checks right on the first meeting. I did some homework, of course, before, but I was like looking for some kind of signals, some facts and everything. But
so I think, and I think on the topic of IP versus talent, I think sometimes we at Village Global will underwrite a founder even if the idea is problematic, if we believe that the founder can adapt and pivot over time. And so sometimes what's really tricky about this style of investing is you're looking for founders who on the one hand are highly committed to their business and unbelievably persistent, and at the same time they're open to change and pivoting. And to have that exist at once is kind of rare to see. Someone who's completely committed and persistent and open-minded to changing if the market gives them feedback that their V1 of their idea is not working. Sandeep or Grant, do you want to weigh in at all?
Well, I was just reflecting on a conversation last night at the 500 Startups Mixer with a guy named Umran, who lives in Stanford, in Palo Alto, goes to Stanford, and is involved in one of the deeper labs. And he said that there's almost a one-to-one correlation between the highest paid AI tech talent and those that have won international math Olympiads. It's math-driven, it's very intense. There's just a very narrow crowd that seems to be able to solve certain problems. I was also talking to Kirill before this, and there's actually some people nearly at that level that aren't getting the attention. So maybe they can broaden that pool, but it feels like overall this high tech talent search is sort of masking some of the core issues. So we're talking about execution, being able to pivot, being able to produce a product, market fit in a reasonably short period of time. All these things can be accelerated, and here we're sort of stuck on certain formulaic things. It feels like this is probably something that's going to drift to the side, and if companies are going to solve things and need, take tools, take some talent, and produce it, get it to market quickly, that's going to become more interesting for at least medium-sized valuations, a lot of ways in which the technology is going to help transform all sorts of sectors of society. So,
okay, let's shift and talk about our kind of third topic, which is this trend of large organizations experiencing slower growth and making acquisitions to try to accelerate growth. And in particular in AI today, you see a lot of these acquisitions or talent hiring processes that deeply resemble an acquisition, but isn't technically an acquisition due to FTC regulation, at least in America. Sandeep, I wonder if you could start by talking a little bit about how you think about acquisitions that are happening today and the degree to which companies are acting rationally when they acquire a business that isn't going to contribute very much in terms of underlying IP, but instead is really just a talent bet. Are you bullish on that phenomenon? Do you think there's wisdom in those decisions?
I'm going to say something that's going to irk you, which is it depends, but I'll give a little bit more.
That's great. Yeah.
No, look, I have the luxury of having gone after somebody like Anu who's been in this for far longer than I have. So what I would say is that it depends. When the acquirer has clarity of thought as to what that acquisition is actually going to do for them, that's component number one. Because ultimately you're acquiring either a team, technology. Ultimately you're bringing them into your product roadmap, your technology roadmap, ultimately your shared vision. So Prosus, for context, we're a $170 billion publicly traded company. We acquire businesses, we invest in businesses, and when I look after our venture business, but when our M&A businesses look to acquire businesses, it's because we have a clear product roadmap. The second question that we ask ourselves, to build on something that you mentioned, was if you're making $1 million and you're sitting next to somebody who's making $100 million, the question that we typically speaking ask our teams are, does your partner, does your team, do they share the same risk? Are they getting up every day because they share the same risk, same vision? And so when we're talking about acquiring teams, it's, do you have clarity of thought? More often than not, when founders come to me exploring M&A, and they're like, oh, we're just acquiring this because it's a smart team, it's not going to work. They're going to run through their earnout, they're going to take the cash, and they're going to figure out to do something else. They want to join with a shared vision, and that's typically speaking what we look for.
Got it. And what would be an example of an acquisition you guys did recently?
We just acquired Just Eat Takeaway for $4 billion. We took it private. It's one of the leading food delivery businesses. And because we have a vision. We have a vision on a European ecosystem. We've seen this play out in Latin America. We have iFood in Brazil, which is a multi-billion-dollar business that's doing, I think, close to 1 billion orders a year. And that we have an ecosystem. We believe that there's an ecosystem. They joined us because we have a vision.
Yeah.
And that's an example.
Got it. Anu, do you want to comment on this dynamic? And you work with a lot of late-stage businesses. They probably are getting acquisition offers from big tech. How is big tech evaluating or valuing the businesses that you've invested in? How much are they focused on CEO quality and the engineering team that could be brought in versus other IP? And in the transactions that you've seen successfully consummated, can those teams integrate into the acquirer successfully, or is Sandeep's concerns around culture, does that often prove an impediment to successful M&A?
I think M&A is inevitable. I mean, you just saw Google acquire Wiz. Facebook wouldn't be Facebook without any of their acquisitions. So I think when a late-stage company gets approached by a potential acquirer, really it comes down to the CEO of the late-stage company to make that decision. And a few parameters come into play. One is, can they accelerate better by just being integrated? 2, do they want to do it? 3, what is the strategic positioning of the current company, right? Sometimes they probably are self-aware to know that they see line of sight to 200 to 300 million revenue in business, but it's going to be a very hard play if they don't have a strong distribution partner. And it's not. I always tell founders, be smart. If you know that you don't want to be a public company CEO, or if you know your company is going to be sandwiched after 200 to 300 million revenue, you have to sell at the right time. But acquisitions are always bought, not sold. If you are at the point of contacting a lot of people to sell, then you're in a tough spot. If people are coming to you because they want to buy, that's the time to evaluate. I think Facebook did the best job of keeping their acquisitions. They gave them room to be standalone with Instagram, with WhatsApp, and none of those CEOs are in the company today. But there was enough time for it to be integrated and for them to be seamlessly integrated into Facebook.
Yeah, it is interesting because that does seem to be the new playbook, like Microsoft buying LinkedIn, keeping it completely independent, Facebook and Instagram. As a different example, you may have seen Grammarly, which is a very substantial business that people underrate or underestimate in Silicon Valley, acquired Superhuman, and then they just renamed themselves yesterday to be Superhuman. So Grammarly is now known as Superhuman. The original Superhuman email app is called Superhuman Mail, and so that's actually an example of a much deeper integration, like literally at the brand name level, and so that can work. It's not always the case that you have to keep these acquisitions as like satellite independent organizations, but it just depends on which playbook makes sense for which group.
Yeah, I would like to add to the discussion and fully agree on the points that Sandeep and Anu made on an example of my portfolio company, and basically this is with regard to the shared vision, skin in the game of the big players with the potential targets, with the potential smaller startups. So one example. Crave Mart, e-grocery delivery in Pakistan. Pakistan, very turbulent market. E-grocery delivery, highly challenging, very high execution business, very tough. InDrive, a big hailing company which might be going to IPO like next year. First, invested in the company, so it's a kind of a skin in the game first. Also shared vision, also expectations to launch the super app in few frontier markets, including Pakistan. And Crave Mart is a great addition as an e-grocery delivery to the hailing business of InDrive. And staged acquisitions over next couple of years. So currently, InDrive owns more than 60% of the company. Few investors still on board, still in the cap table. Company is doing tremendously well, all because of the shared vision of the target, skin in the game of the acquirer of a big player.
Okay, so to wrap, we just have a few minutes. I was curious, just in the broader topic of talent, Anu, what do you make of Meta's current AI talent hiring process? Are you bullish? Do you think in 2 years Meta Superintelligence Labs will have retained the superstar OpenAI engineers that they've recruited, or would you guess that culturally, too many superstars, it's not going to work? What's your sense?
Well, I don't know. I would only say don't bet against Zuck, but he has nothing to lose. I mean, I actually think what he's doing is the right strategy. I mean, they have, I don't know, like multiple billions of dollars of free cash flow, and in the AI race, if he doesn't participate, it is existential to Facebook. And so he is doing the right thing by concentrating talent, but he's trying to do it in a very compressed time frame as a fourth player in the market. So only time will tell us, but I think he's making the absolute right bet. Will it absolutely work out? We don't know.
And I guess, does this, for those who claim that, like, I guess his thesis is that the difference between an A- to A talent and A+ is worth paying a massive premium for, right? Because if the public reporting is accurate, some of these AI engineers, researchers are getting paid hundreds of millions of dollars over 2 or 3 years, whereas the next best person's, maybe getting paid between $1 and $10 million. The idea that there are returns to the organization that accrue from the A+ talent versus the A- is really a fascinating sort of hypothesis.
I think we are too anchored on the amount he's paying and the different grades. If they make 50 billion in free cash flow, to spend 10 billion is no big deal. And he's trying to do this in a 10-month time frame. And if he needs to put a model out there that matches and does better than OpenAI and Gemini, you have to do his strategy.
Yeah.
He needs the talent and he needs the build out to happen in less than a year. He's not planning for 5 years.
Yeah, yeah, interesting. And Sandeep, when you think about what's happening at Meta, given your comments about cultural integration, how do you foresee an organization full of super compensated people? How do you see that playing out?
Yeah, so again, I would echo Anu's comments around don't bet against Zuck, but more often than not, what I've also seen is even A players want to learn from A+. And whenever, and irrespective of what it is that they're making, more often than not, the A+ is justified. I mean, again, if we don't anchor on the value, if we just anchor on the philosophy that A+ is justified, then everybody from A to A- to B will really see value in learning from those people, and then ultimately hope in the future to command those. So
yeah, it's a good point. I guess the argument that if you get the world-class people at A+, it will help you recruit the B+, A-, A people more effectively. I don't know. The issue is just like when it's like keeping up with the Joneses. Everyone feels like they're poor if all their neighbors are rich. You feel rich if all your neighbors are poor. An American friend of mine who's here in Riyadh for the first time in Saudi said, I feel much poorer than I did before I came on this trip because he's been spending some time at some very luxurious houses. And he texted his wife saying, we actually are poor. So who you surround yourself with makes a big difference. So I wonder just internally, like, oh, I'm inspired by the A+ person, but don't you also resent that person at some level for having so much more money than you?
I think, and it goes back to one, what is the vision of the founder? What are they solving for? But two, I think that over the test of time, if a quarter, 6 months, a year, if they're not able to deliver, and let's go back to anchor on the conversation, it's about talent versus roadmaps. If they're not able to achieve the product, tech roadmap, the revenue, the customer delight, then of course that will harbor resentment. But that's
true. And many of the comp packages at Meta, similar to Tesla and Elon's pay package, is dependent on real performance, right? Elon's not going to make $1 trillion no matter what. It's only if some extraordinary benchmarks are achieved. So thank you all very much to the panelists. We're going to take a 2-minute break, and then we'll launch our next debate on mega funds and venture capital. So thank you very much, and we'll bring the next group on.
Thank you.
Take care.